In the cross-asset solutions team at Unigestion, we think investors can benefit from some lessons learned in sailing. For starters, a mono-hull boat isn't as stable or efficient as a multi-hull one. It's the same in investing. A traditional passive portfolio of bonds and equities will not be as stable or efficient as a portfolio of diversified dynamic return streams. And we strongly believe the performance of such a portfolio is driven by 4 key macroeconomic regimes: steady growth, recession, inflation surprise, and market stress. So we built a long-term strategic portfolio that's diversified across economic cycles by allocating risk proportionally to each of these environments. That's the first part of our enhanced diversification, where we diversify across macro regimes. And like the custom sails on a ship, we use a variety of return streams or risk premia in our portfolio to handle any weather conditions. That's the second part of enhanced diversification, diversifying across risk premia. So we invest in a broader universe of traditional risk premia than just equities and bonds. We also invest in alternative risk premia since they provide cost-efficient, lowly correlated liquid returns. Now in sailing, when the sky's clear and there's a strong wind behind us, our sails should be all open. And it would be foolish not to lower them when a storm's approaching. Investing, the same principle holds. It's critical to adapt your long-term strategic portfolio and dynamically manage risks depending on the macro and market conditions. The key issue is accurately assessing the global economy in real time. So just as a sailor uses tools like a barometer to check the weather, we use our proprietary NOWCASTERS to measure current global economic conditions and adapt our portfolio over the shorter term. The NOWCASTERS are 100% systematic signals that point us to which macro environment we're in so we can steer the portfolio in favor of those risk premia that should outperform. Finally, we don't believe risk is a single statistical measure. That's just the tip of the iceberg. For us, risk is about what's underneath the surface, it's multidimensional, it's about capital loss. For example, different risk premia can look similar when you're using a single simple measure like volatility, but looking at what sort of drawdown you can face quickly delineates which are more or less risky. We believe this robust approach to risk, combined with enhanced diversification and dynamic risk management, is key to ensuring a smooth journey for our clients. Thank you.